Today's session, we will be discussing classification of costs. And as a part of today's session, the classifications that we are going to be discussing, all these are a part of your decision-making process. These are unlike the cost classifications that we had discussed in the previous session. The classifications of costs that we are discussing in this session right now, it is from a decision-making point of view. These classifications you may not find. It is applied or it is used exclusively as a part of your decision-making process. Now, these are costs. All the costs that we'll be discussing as a part of today's session. These are costs that these are specially computed. Okay? So, which means these are costs which are not part of your routine business activity. You're computing them, you're calculating them, you're trying to evaluate the measure of these costs as a part of a specific need. Okay? Now, the need why you would end up computing these costs is because you want to help your management. Okay? So these are costs, these are basically inputs which are taken by your management so that they could go about with their decision-making process. Okay, so these are costs which are specifically computed, these are specifically calculated so that your management could go about carrying out their decision-making process. Now, why does the management need these costs? Management needs these costs so that it will enable them to take better business decisions. Okay, the reason why these costs are calculated is so that your business could go about taking better business decisions. So that's the reason why these costs are calculated. Now, it can so happen that these costs may not be recorded or disclosed in your routine books of accounts. Okay, these costs may not be recorded and disclosed in your routine books of accounts. So some of these costs, you may not see them directly disclosed in your journals, ledgers, trial balances, etc. Okay? But we would still need to calculate these costs. And the reason why we would still need to calculate this cost is because we would need them for the sake of management to take better business decisions. That's the reason why these costs are still calculated. That's the reason why these costs are still computed. So the first cost that we're going to be discussing is called as sunk cost. Okay, it is called as sunk cost. Now, what is meant by sunk cost? As the name suggests, it is a cost that you are writing off completely. Okay, it is something that you don't have an option to recover. You don't have an option to recoup. Okay, so such kind of costs are called as sunk costs. Okay, these are costs which are already incurred, and irrespective of whatever your management tries to do right now, you may not be able to get the money back that you have incurred as a part of these costs. Okay, so such costs are called as sunk costs. These are costs that has been written off. Okay, your business firm is not in a position to recover these costs. So we will talk about maybe an example of raw material. Now, if you have to produce a good, if you have to produce a service, if you have to render a service, it so happens that you may need some inputs for it. You may need the inputs in the form of raw material. Now, the cost of that raw material, you are recovering as a part of the price of your good or service. Okay? So the cost of the raw material, you're recovering as a part of your price of your good or service. Now, so which means the cost of raw material you're able to recoup. Okay? The cost of that raw material you're able to recoup. Likewise, there may be some costs in your firm, but no matter whatever you try, no matter whatever you do, you may not be able to recoup this cost. You may not be able to recover this cost. So such kinds of costs are called as sunk costs. So I'll give you an example. Let's say the company spent a few lakhs of money to carry out a feasibility study. Okay? They wanted to do a market analysis when they wanted to launch a product. They did some market analysis. Okay? So according to the market analysis, the price of the product is supposed to be very good. It is supposed to be fast moving, etc. But when you brought out the product into the market, it so happened that the product failed miserably. You brought out the product, you did all your market analysis, you did all your preliminary checks, you did all that, you gave samples, you asked people about their opinions, you asked how do they feel, so all this will involve a cost. Okay, whenever you have to carry out a feasibility study, you have to always, there is a cost which is involved. So especially if you have to do market analysis, you may have to give some pre-samples. You may have to give some special discounts. Okay, so for example, there is this company called as Garuda Foods, and I'm pretty sure you must have seen the cheese crackers. It's called as Gone Mad. Okay, so those cheese crackers, when they see cheese, the concept of cheese crackers is very new in India. Okay, so when the company came, Garuda Foods, which is a Malaysian-based company, when they came out for the very first time in India, what they did was they used to send out their representatives. They used to stand in supermarkets. They used to stand at these food stalls, and they used to give free samples to people. Okay, now to hire the people to do the distribution, you have to pay them remuneration. Now to give them free cheese crackers, you have to pay them some amount. There is a cost involved. So all this is a part of your market analysis. Okay. So likewise, your company spent a few lakhs altogether. They carried out a market analysis, but irrespective of carrying out the market analysis, your product has failed miserably. Now, the only option that you have right now is to kill the product line completely. The only option that you have right now is to kill the product line completely. Now, when you kill the product line, what is happening is the money that you spend for your market analysis, okay, the money that you did for your surveying the market, you're not in a position to recoup. You're not in a position to recover that. Okay, so that is gone. So that would be an example of a sunk cost. So sunk costs, these are costs which are already incurred by your firm, but no matter whatever you do, your firm is not in a position to recover the money back. Such kinds of costs are called as sunk costs. Okay, such kinds of called. So let me share an example with you from the industry. The example that I would like to share with you from the industry is that of Nokia. We all know Nokia was a mobile manufacturer. We all know that Nokia was a mobile manufacturer, and they were once upon a time the largest market player. And but pretty soon things didn't work out very well for them. So their market share kept declining. It kept declining, and then finally it so happened that Microsoft decided to come out and acquire Nokia. Okay, so this happened sometime in 2000, and this happened towards the end of 2013. The time this acquisition was happening, Steve Ballmer, the person called as Steve Ballmer, he's one of the co-founders of Microsoft, and he was the CEO of Microsoft back then. And Nokia was headed by a person called as Stephen Elope. Nokia was headed by a person called as Stephen Elope. Okay. So Steve Ballmer gave a proposition. Steve Elope did the analysis. Steve Elope from Nokia, he did the analysis, and he found out that it would be better for Nokia to get acquired by Microsoft, because Nokia didn't have much future ahead. Now, the reason why Steve Ballmer went ahead and did this was because Microsoft did not have a very good presence in the mobile industry. So he was very ambitious. Microsoft wanted to keep up with the competition of Apple, and then they wanted to keep up with the competition of Google, because that was around the time that Android was catching a lot of attention in the market. So they wanted to sustain the competition. They wanted to be the market leaders. So Microsoft decided to go ahead and acquire Nokia. And the price that they paid back then was $7.6 billion. Okay, so Microsoft decided to acquire Nokia for $7.6 billion. Okay, and it was $7.6 is a huge amount of money. Okay, we are talking about a few thousand crores altogether. So the reason why Microsoft took this radical decision was because they wanted to step up the competition in the mobile industry. However, in the long run, this strategy did not prove to be very good, because Microsoft, they rebranded the Nokia mobile division. They called it as Microsoft Mobile, Mobility Technology, but that did not prove to be very good. That strategy did not pay off very well, and it so happened that the company was not able to sustain against the competition of Apple as well as Google with Android. and they eventually lost out the market. And when Satya Nadella took over in 2017, so one of the first few decisions that he took was he decided to close down their mobility division completely. They decided to close down their mobile segment completely. Okay, so now here's Satya Nadella coming and telling, okay, boys, let's close up our mobile segment completely. But a few years back, Nokia had spent $7.6 billion to acquire that mobile division. So what has happened? Now that $7.6 billion that the company has spent to acquire Nokia, that has become a sunk cost for Microsoft. Because despite having the mobile division, they felt that if they were to continue with the mobile division, they would have to unnecessarily pay salary to the people there. They will have to spend a lot of money on the facilities. They will have to spend a lot of money on research and technology. So it would be a lot feasible for them to shut down the division completely. That's the reason why Satya Nadella took that decision, which the decision by itself was correct, or it was good for the company, because as of now, Microsoft is doing extremely well, especially in cloud computing and those segments, they're doing very well. Okay? But if you look at the money that Microsoft had spent to acquire Nokia, that has become a sunk cost. So $7.6 billion that the company had spent, it has become a sunk cost for the firm. The next cost that we would be discussing is what is called as the replacement cost. Okay? The next classification of cost that we would be discussing is replacement cost. Now, what is meant by replacement cost? Replacement cost refers to the cost that is incurred by your firm to replace an asset. Okay? So the market cost that is incurred by your firm to replace an asset, that is what is referred to as a replacement cost. Now, when we talk about replacement, we are not talking about replacement of an asset alone. We are talking about replacement of machinery. We are talking about replacement of technology. We are talking about replacement of manpower, etc. Okay? So if you look at the present scenario, we have a lot of artificial intelligence coming into picture. We have the concept of machine learning which is coming into the picture. So what is happening is companies will have to invest just one time into technology, and it could so happen that whatever a certain group of manpower could do, it could be handled easily by a group of machines. Okay, so such kinds of costs are called as replacement costs. So the market cost that you incur in terms of replacing an asset, that is called as a replacement cost. Notice here I have very specifically used the term replacement cost. Now, why did I use the term replacement cost? The reason why I've used the term market cost is because sometimes for you to replace an asset, it could be technology, it could be manpower, it could be your mode of production, it could be your manufacturing technique, it could be your manufacturing process by itself. So there may be some other costs which are associated. You may have to do a feasibility study, you may have to do some kind of training, you may have to do some kind of a sanity check, you may have to do a feasibility study. So there are a lot of things which are associated with it. So sum total of all that cost is what is called as a replacement cost. Okay, sum total of all that is what is called as replacement cost. So for example, you decide to switch over from labor intrinsic to machinery intrinsic, a mode of production. Okay, you decide to switch over from labor intrinsic to machinery intrinsic. Okay, so see, so when you are switching from human intrinsic method of the production to machine intrinsic method of production, it may not be so easy. You may not be able to do that in one go. You may not be able to carry out the changes in one go. Okay, so there may be some elementary analysis that you may have to carry out. You may have to see what are the feasibilities which are available, what are the kind of technologies which are available. There may be machinery that you would be needing. You may have to give VRS, voluntary retirement services, to your existing employees. So sum total of all that is what is called as replacement cost. So I'll pick up on this also with a market example. 2016, Bata India, the famous shoe manufacturer, they decide to step up their presence in India, and they decide to invest around 300 crores to modernize their manufacturing facility. So they had very good manufacturing facility in 3 states, West Bengal, Bihar, and Karnataka. And what they decided to do was they decided to invest heavily into these 3 facilities, because a lot of their processes were human centric. A lot of their processes were labor centric. They decided to give away with all that, and they decided to switch over to machine centric form of manufacturing. But eventually what happened was this benefited the company in the long run, because they were able to add new retail stores, they were able to start new franchisee stores, as a result of which their sales volume went up. Okay, so notice how the company invested into modernization of its plant, and how the benefit translated to the sale of the company. So all this is together what is called as the replacement cost of the firm. Okay, sum total of all this together is what is called as replacement cost of the firm. Now there's something which is the next cost that we will be discussing is called as the differential cost. Okay, the next cost is what is called as the differential cost. Differential cost is sometimes also called as incremental cost. Now, what is meant by differential cost? It is the increase or decrease in the total cost because you're deciding to choose an alternate course of action. So until now, you were doing things in a specific manner. You decide to change your track, you decide to do things differently right now. So because you decide to do things differently right now, there is a change in your cost. Okay? So that change in cost is what is called as differential cost. Okay? That cost is called as differential cost. So for example, if you look at the saloons, if you look at saloons, what will happen is you would go to a saloon, you would sit there for saloon, you would sit there for a haircut, and there is a cloth spread that the barber will give you. Okay? So the cloth spread he will tie around you, and that's when he will start cutting your hair, just to make sure that your dress does not get your clothes do not get soiled in the due course of haircut. Okay. Now, which means routine, what the barber would do is he may probably wash that once in a day, or he may wash that once in a week. Okay. Now, depending on the hygiene level that the barber prefers to maintain. But in the present COVID situation, what is happening is people are hesitating to go to barbershop because of all the norms and all that. Okay. But imagine if the barber continues to do the same old practice. He is using one cloth for everyone. He is using the same spread. He is using the same cape for everyone. People will not be very happy about it. People will not be able. So now what has happened is a lot of these barbershops, they have adopted disposable capes. Okay, so you would come, you would sit, he would use a disposable thing, and as soon as your haircut is over, he would wrap up the entire thing and fold it up and then dump it or dispose it off somewhere. Okay. Now, this is something that the barber is forced to do right now because he wants to change his entire business processes to suit the present scenario. This was not there previously. Now, that the disposable cape that the barber is using, it is quite costly. It is quite expensive. So what the barber would do is barber will now increase the price of the haircut. Okay. So now what has happened? Let's say conventionally your haircut was like 80 rupees. And because of this, now it's 120 rupees. The differential cost in that scenario is 40 rupees. Okay. Now, until now, the barber was carrying out haircuts for people in a specific way, but due to present corona condition, due to the present pandemic condition, he's forced to do things in a different way. The difference of these two is what is called as a differential cost. Okay. The difference between these two is called as differential cost. So I'll pick up on a market example for this as well. Urban Clap. The company has started something which is called as grooming services at home. So you could call, you could book. The Urban Clap will send out their hair specialist to your home. You could sit at your home, and then they would carry out the haircut. Okay, so he would come. The person would come with his entire kit. He would have a spread out in your room. He would give you a disposable cape. He will sanitize all his equipment right in front of you to make sure that the hygiene process is maintained, etc. He would do all that. Okay. Now, because urban clap is forced to carry out their business practices quite differently right now. There is an increase in their cost of services. So this is what is called as differential cost. Okay, this is what is called as differential cost. So in a nutshell, it can be calculated by subtracting cost of one alternative from the cost of another. Okay? It can be calculated by subtracting the cost of one alternative from the cost of another. So you were doing things specifically according to plan A, but now you're forced to do according to plan B. So cost of plan A minus cost of plan B, that will give you your differential cost. Now, this could be positive as well as negative. It's not necessary that it always has to be an incremental in nature. It could be positive or it could be negative in nature. The next few costs that we have to discuss, the first is called as marginal cost. Marginal cost, I do not wish to spend too much of time, I do not wish to spend too much of time to explain marginal cost to you. Marginal cost is also called as variable cost. It refers to the cost that is incurred by your firm to produce one additional unit of a product. It refers to the cost that is incurred by your firm to produce one additional unit of the product. So that is called as marginal cost. Now, marginal cost calculation, it helps your firm to decide on, what is, should we make the components or should we buy the components, or what is the sales mix that your firm has to do, etc. So all this can be calculated with the help of marginal cost. Okay, so for example, we had picked up on the example of car manufacturer deciding to manufacture tires. Okay, so a car manufacturer, as a part of the car completion process of the car manufacturer, the manufacturer needs tires for sure. Now, the car manufacturer has got two options. Either he could decide to buy the tire, or he could manufacture the tire all by himself. So if he decides to go for manufacturing, what is the cost? If he decides to buy, what is the cost? You would try and compare these two costs, and then you would decide on the price. So then there's something which is called a sales mix. What is the proportion of products that you should have? Okay, what is the proportion? Should you have more of product A or should you have more of product B? This is called as a sales mix. So all these are determined with the help of marginal cost. In a nutshell, marginal cost refers to the cost incurred by a firm to manufacture one additional unit of a product. Okay, that is called as marginal cost. Then opportunity cost. Okay, the next is called as opportunity cost. Opportunity cost refers to the sacrificial cost involved in accepting an alternative. Okay, so I'll explain this to you with an example. We had a BBA student a few years back, and the student, while the student was graduating, the student got a job offer with a company, and let's assume they were paying 5 lakh rupees as the salary package. The student, in a way, was very happy to get such a high salary package, but was quite unhappy because he had to relocate from Bangalore. He had to go all the way to Chennai if he had to pick up this job option. He was not very happy about it because his family was all settled here. He grew up, his entire lifetime he had spent at Bangalore, so he had all his friends over here. So he was contemplating, should he go for this or should he not go for this? Now, in the meanwhile, he got another option. He got another opportunity with a company in Bangalore itself. He got another opportunity with a company in Bangalore itself. But the company in Bangalore were now offering only 4 lakh rupees, which means his total salary package has now come down by 1 lakh. Okay? So his salary package has now come down by 1 lakh. So, but however, he decided to go for the company in Bangalore despite being given a lower salary package, because he was very happy about it. Now, in his case, the opportunity cost was 1 lakh because he decided to go with an alternate. He decided to choose another alternate. So the sacrificial cost that student had incurred for choosing the company in Bangalore over the company in Chennai is what was his opportunity cost. So the sacrificial cost involved in accepting an alternative is called as a opportunity cost. Okay? So the sacrificial cost involved in accepting an alternative is called as opportunity cost. So tomorrow when you join firms, when you join businesses, you may have scenarios where the same product would be supplied to you by different companies, but there are certain riders. There may be certain other things that you may be anticipating. So such kinds of costs are called as opportunity. So in such cases, what you will do is you would have to evaluate your opportunity cost and then take a decision. Okay? Then you have to take a decision. So such kinds of costs are called as opportunity costs. Okay? Such kinds of costs are called as opportunity costs. The next cost that we will be discussing is called as imputed cost. Now, I want all of you to pay attention to imputed cost because for you to understand this concept, it may take a little while. Okay? These are referred to as notional costs, which means imputed costs are costs which do not really exist. Okay? They do not exist by itself. These are costs that you make up. Okay? These are costs that you are making up. But the reason why, now when I use the term making up a cost, you may feel that it is a part of maybe some illegal or a fraud activity. No, that's not the case. The reason why you have to make up these costs is because if you don't factor these costs, your calculation or your computation may not go correctly. It may not go in the right way. If you still do not factor these costs, what could happen is it may not go in the right way. So these are basically hypothetical costs. They are specially calculated. They are beyond your accounting system. You're making up these costs. But the reason why you're making up all these costs is because you will have to calculate these costs as a part of your decision-making process. Else your decision-making process may not be apt. It may not be correct. So I'll touch upon this with an example. Imagine you're a firm and you're running in your own rented premises. Imagine you're a firm and you're running in your own rented premises. So you're running in your own premises. You don't have to depend on a rented premises at all. You don't have to depend on a rented premises at all. Now, the cost of buying the land and setting up your manufacturing plants, all these were one-time cost. Okay, all these were one-time cost. But if you have to price your product, now let's think about the cost that you will be incurring. Since you're running out of your own facility, you don't have to pay rent. So it is not at all a cost for you. Your possible cost would be the salary, the remuneration that you're paying to your labor force and your raw material. Okay? But if you consider only these costs, what could happen is that your product may end up being priced inappropriately. It may not be priced correctly. It may not be priced correctly. So for example, you decide to start a hotel and you decide to start a hotel in your own shop. The shop is owned by you and you decide to... Now, in such cases, you don't have to pay a rent. So your only cost would be the raw materials you're consuming as a part of cooking your dishes and maybe the remuneration that you have to pay to your labor force. But if you were to calculate the price of your food items in such cases, it would be way, way lower than all your competitors. That is also not very good. If you end up pricing your product too low, it may not be very good because we have anti-competition laws and all that, predatory pricing laws and all that. So it may not be a good idea. So you may have to give a notional expense. You may have to come up with a notional cost for that rent of your facility. You may have to come up with a notional rent, though you're not paying it up, so that you can price your products effectively. So such kinds of costs are called as imputed costs. Okay? Such kinds of costs are called as imputed costs. So these costs are basically costs that you are notional. They do not exist in real business scenarios. You're just making it up so that you could go about taking better business decisions. So such kinds of costs are called as imputed costs. So with that, I will like to wind up with the discussion on classification of costs based on decision making. So let's quickly have a recap of what we have learned as a part of today's class. Okay. So we started off, we saw that costs can be classified on the basis of decisions which are taken. I also explained to you these are costs which are specially computed. The reason why these costs are specially computed is because in order to help your decision making process, it can so happen that these costs may not be disclosed as a part of your books of accounts. They may not be a part of your routine business processes or your accounting processes, but you would still need to measure, you would still need to calculate them so that your decision making process is correct, it is intact. Some of the classifications that we had touched upon, one was the concept of sunk cost. So I told you sunk costs, these are costs that you have already incurred, but due to certain how business has eventually turned out to be for you right now, you're not in a position to recover this cost at this point of time. Hence, you're forced to write off the cost. Such kinds of costs are called as sunk cost. Then we had discussed a few examples based on this. Then we had spoken about replacement cost. I told you replacement cost is the total cost, the market cost which is involved in replacing an asset. So is the sum total of all this is what is called as replacement cost. Then we had discussed what is meant by differential cost. So differential cost refers to the difference in the cost, because until now you're carrying out your processes in a certain way. Suddenly you decide to switch over, as a result of which there is a difference in the cost. Such kinds of costs are called as differential cost. Then you have what is called as marginal cost. Marginal cost refers to the cost that is incurred by a firm to produce one additional unit of a product, and that is called as marginal cost. Then you have opportunity cost. Opportunity cost refers to the sacrificial cost involved in accepting an alternate. That is called as opportunity cost. The last cost that we had discussed was imputed cost. I told you these are notional costs. These are costs which are made up. These are costs which are given certain values because to make sure that you're taking the right business decisions, to make sure that you have the right outcomes. Okay. So such kinds of costs are called as imputed cost. So with that note, we've come to the end of today's session. We will continue with the further discussions in the next session onwards.